Hello everyone, welcome to Bold Conjectures with Paras Chopra. In a world dominated by big companies with billions of dollars in investable capital, why should tiny startups be successful with anything? After all, startups are less capitalized, have a non-existent brand, and often the products they release are pretty basic. Our today's guest, Jerry Neumann, spends his time thinking about why startups are able to grow despite being surrounded by big companies. Without giving away too much of his ideas, the one theme that he explores very deeply is the concept of uncertainty and how counterintuitively it is the key to a startup success. Jerry is a venture capitalist within multiple investments in popular companies like DataDog and BankSimple. He also teaches entrepreneurship at Columbia University's engineering school. He writes a blog called reactionwheel.net, which I will highly recommend to everyone to read after they're done listening to this podcast. His writing is crisp and his ideas are compelling. I will put a link to his blog in the description. Welcome, Jerry.
Thanks. Glad to be here.
So I wanted to start the conversation by really understanding your career trajectory. How did you end up becoming a VC? And after that, how did you end up winding teaching entrepreneurship at Columbia University?
Okay, so yeah, I became a VC by accident. I was working for early on in 1995. I was working for a company called Prodigy, which was one of the first internet service providers in the United States. And a couple years in, when the company looked like it wasn't going to succeed, it wasn't going to be the winner, I started looking for a job. I got hired at a company called Omnicom Group, who was looking for somebody to help them buy internet companies. They're a holding company. They own thousands of companies around the world. They wanted to buy companies in the internet space. And this was in New York. So they looked around and they wanted somebody who knew something about the internet and something about finance. And in 1997, when they hired me, I was the only person in New York who knew anything about the internet and finance both. So they hired me. And it turned out that instead of buying companies, we started investing in companies, because none of the good internet companies would let us buy them for any reasonable price, but they were happy to take money as an investment. So I ended up becoming a VC really by accident. It wasn't what I was hired to do. It was what I was kind of forced into at the time. The companies we invested in were very successful. It was the dot-com bubble. So they grew very large very quickly. And Omnicom ended up making quite a bit of money from that portfolio. And then when the dot-com bubble burst, they decided not to keep investing. So I went off and I started my own company, became an entrepreneur, did that for a few years. It was reasonably successful to the point where the lead investor decided he wanted to put his own people in charge and fired me and my co-founders. And then the new management ran it into the ground 2 years later. And at that point, I started investing again. So I went back to the new management had a very different style than we had. And a lot of the people we had hired decided to go off and start their own companies and say they continue to work at that company. So they would call me and say, "How did you raise money for this company?" And I said, "Well, let me introduce you to some people. Let me help you figure out, your pitch, and I'll put some money in also." So I started investing again, and as an angel investor, and that ended up becoming a full-time job a few years later. So, some people like you mentioned BankSimple. Josh Reich, who started BankSimple, was one of our first two employees. At my company. So the reason I backed him was because I knew him from having worked with him for a few years. Greg Yardley was the other first employee, one of the other first two employees, and he started a company which became Flurry, which was bought by Yahoo a few years later. So there were a lot of really smart people that we managed to hire who became very successful after they stopped working for us. And I managed to invest in them because I knew them and I could help them at least at the beginning. So that's how I got back into venture capital. I've been doing it now, I guess it's been like 13 years now on my own. So,
right. And how did teaching happen? Teaching gig?
I had a couple of times. I went to Columbia University, where I now teach, and I had tried to engage with them a couple of times. Once when I was at this, big, huge company, this Fortune 500 company, where I was a venture capitalist, trying to engage with them, thinking about Silicon Valley and Stanford, and saying, well, if New York is ever going to be a center of startups, having a university which is really engaged in that would be useful, just like Stanford is with Silicon Valley. So I approached Omnicom and I approached Columbia, and they were kind of like, yeah, great. Why don't you just give us money? Which is, probably talking to the wrong person, but I couldn't get them to really engage. And then a few years later, I tried again to get them to engage when I was running my own company, and I really couldn't find the right people. And finally, I complained on my blog about it, and one of my friends connected me with a professor there who had been working with would-be entrepreneurs at Columbia and helping them get out in the world, a guy named Chris Wiggins, who started Hack NY. And he called me up and said, hey, let's talk about this. And so we went and talked about it. And he said, well, what do you think the university should do? I said, well, I think you need an entrepreneurship program. I think you need to be teaching classes. I think, he's like, well, we have all that. I said, well, how come nobody in New York knows it? He said, well, I think the people who are teaching it are teachers, not people from the community. So there's not a lot of real interaction. I said, well, you need to hire people from the community. He's like, well, who would want to, if they're working in this field, would have the time and the willingness to come to Columbia and, teach entrepreneurship, when they have all this other stuff they could be doing. I was like, oh, I don't know. He's like, well, can you think of anybody, maybe somebody who went to Columbia who's really passionate about this, who thinks we're doing a bad job and could really teach this? And I was like, oh, okay, I see where this is going. So he kind of drafted me into doing it. And I've been doing it now about 10 years, and I love it. I love the teaching. I really, it's amazing to be in front of the students who hope to become entrepreneurs and talk to them about it and try to convince them that this is a viable career path for them. They don't have to go work at an investment bank or work at a VC or work at some safe job, but they can go out and take some risks and start a company. It's really rewarding, especially when they come back years later and say, hey, I'm raising a round, or I had somebody come back just last year saying, hey, I'm raising my Series C. It's great to have people actually do it, and call me and say, hey, thanks. It helped to take your class.
Right. So on that note, I think teaching entrepreneurship does sound a bit paradoxical. There's this perennial debate whether entrepreneurship can be taught or whether entrepreneurs are born. So was curious, how has your thought evolved on this question? What have you learned from teaching? What are the are you teaching skills? Are you teaching knowledge? What exactly are you imparting to your students?
Yeah, I think about this right before every semester starts. Like, what is the point here, right? I think actually, to some extent, the people who are the most entrepreneurial students at Columbia don't take my course because they feel like, the people who are really entrepreneurial have this feeling that they can just do it, right? That's part of being able to do it, is just saying, well, I can just do it, So they I don't need to take a course. I can just go do it. And I understand that. I think it's wrong. I think there are things you can learn. I don't think you can learn to be an entrepreneur in the sense that you'll have the attitude you need to be willing to take that chance, right? So, if you go to university, you can get a good job. And I think in some respects, the job you can get out of a good university has a higher expected value than starting a company, right? Just because so many companies fail. And so if you have a job offer at, Goldman Sachs or something, like, yeah, your expected value there is higher than starting a company. But, and I teach at the engineering school. If you're an engineer, the banks like to hire engineers because they can do math, right? So they're like, oh, here's somebody who can actually do math. That's great. That's one box to check. But if you're an engineer, the reason you became an engineer, and I was an engineer, is because you want to build things. And if you go to work for a bank, you're building spreadsheets, right? So it may not be the career they're looking for, and they may not really get the satisfaction that they want from that job. So I just want to give them a different path. And so I teach several things. One is I teach them that they can, right? They give them permission. And I think this is probably, it's kind of silly, I guess. And I wouldn't want to tell Columbia this because they think I'm actually teaching, really deep truths. And I'm doing that too. But really, what I think, I was an engineer, and I grew up as a computer geek, and I idolized Steve Jobs. I idolized Bill Gates. These people who when I was a kid, were these successful people changing the world, and I idolize them. But when I graduated as an engineer, I didn't think of becoming an entrepreneur. Not then. I mean, I did later. I'm so much happier, but I didn't think I could be Steve Jobs. I mean, how could anybody be Steve Jobs, right? It's an unreachable goal, especially the mythology that was built around him even then. So what I'm teaching them is you can be an entrepreneur. You can, and I bring in people who are not, there's plenty of people who've built and sold successful companies who went to Columbia and would come speak to my class, but I don't want them. I want the people who are just starting companies, who are, either starting now or a year in, and to show them that they're just like them, right? They're no different. They're just normal people who are starting companies, and that they too can be one of those people and start a company. So that's part of it. It's just, you can be an entrepreneur, and people like you do become entrepreneurs and are successful. So that's part of it. Part of it is skills. I mean, I think there are skills you need to know, and skills that are useful, especially in evaluating ideas when you're starting, that kind of thing. But the real conundrum I face every semester is, what's the difference between starting a small business and starting what we call a startup, right? And small businesses are startups. If you start a restaurant or a dry cleaner, or a law firm that where you're the first lawyer, it's a startup. You're starting a company.
Yeah.
But these are really different than starting a company which could be the next Apple or the next Google, right? I mean, I think there's it's not a quantitative difference, it's a qualitative difference. They're different types of companies. So the question is, what's the difference? What's the difference between starting, a restaurant and starting the next Google? And that's what I focus a lot on, is that difference. Because if you want to start start a small business, you're better off buying a copy of, Starting a Small Business for Dummies than taking my course. It's a lot cheaper. And frankly, it's more comprehensive advice. The things you need to know to run a small business, like accounting and management and, operations, like these things you don't learn in a class like mine. I'm not teaching accounting. You need to know accounting to run any business, but I'm not teaching it because it's not really the value added piece that I can do. So this is the question, right? I think it's the question that is the core of most of my work, is what is the difference between a small business and a startup, capital S startup. And that's what I'm really focusing on, is that difference. That's kind of the more, in some sense, academic piece, but I think it's the really interesting piece.
So I guess what you're saying, you sort of challenge them to first to believe that they can be the next Steve Jobs, and then you show them the difference between Apple and say a restaurant next door. What's the qualitative difference?
And the difference, I think, is this uncertainty that you mentioned that I've written about. And we could talk about uncertainty. I think
let's do that. I was thinking most people actually run away from uncertainty. We love to be sure of things, but you say that that's what fuels a startup growth, and entrepreneurs should embrace and probably even seek uncertainty. So what's uncertainty, and why should entrepreneurs embrace it?
Yeah, and I think you have to embrace it. And so it's a really old concept, right? If people have been writing about entrepreneurship for a couple hundred years, economists, since the beginning of economics, because obviously there's always been entrepreneurs, going outside and doing something new. And economists have asked themselves, well, what's different here? And the oldest answer really is the difference is this uncertainty. And when I say uncertainty, it means the inability to predict what's going to happen, right? And this may seem when I say that, it sounds obvious, right? Of course you can't predict what's going to happen, but I mean, you can't predict even probabilistically, right? Statistically, you can't say there's a 20% chance this is going to work or 15% chance it's going to work. You can't really pin a probability on it at all, because you don't have enough data to do that. I mean, now you could say, and you might say like, oh, there's a 20% chance, and this is a statement of your belief, but it's not an analytical, computed answer. So most people and most businesses would prefer to have a computable answer, right? Something that's they would, if you give people the choice of, a 50-50 chance of winning a lottery or an unknown chance of winning a lottery, they would choose the 50-50 chance. This is it's called uncertainty aversion. There's papers written about it, there's experiments run. People prefer to have a known probability of winning versus an unknown probability. So there's a famous experiment where you have an urn that's full of white and black balls, and you say, okay, there's 50 of each. And if you pick a white ball, you win. If you pick a black ball, you lose. And you bet some money on that. And then there's another urn where there's an unknown number of white and black balls. And it's the same thing. If you pick a white ball, you win. If you pick a black ball, you lose. And they say, well, which would you rather do? And they'll say, well, I'd rather pick the 50-50 one. Okay. Now we're going to do the same thing with the same urns, but now you win if you pick a black ball. Now, which one would you prefer? They say, well, I'd rather pick the 50-50 one, right? So, which doesn't make sense, right? Like rationally, like if you think there's more white balls in the other urn, the unknown urn, then you would pick that one the first time. If you think there's more black balls, you would pick it the second time. If by picking it neither time, you're saying, I just don't want the uncertainty. So this idea of not being able to predict is something that people don't like. And it's something that big companies don't like, right? So if you're starting a company which is predictable, no matter how big it could be, then somebody else, some big company is going to see that and say, okay, I get it. We could put money in and run this. And by predictable, I don't mean like you know how to win. You know how to make it work. I'm saying if you say like there's a 20% chance this will work, then Google will do it, because they could say, 20% chance I can have 5 different one of these and one of them will work, right? Where if you say there's an unknown chance it will work, they won't do it, right? And this uncertainty is what keeps the bigger companies out of your business, and this gives you time to succeed. Because you think about, everybody talks about moats, right? You start a company, you need a moat to keep out competitors. What moat do you have as a startup, right? I mean, like if you're really starting something from scratch, maybe you have a patent, right? Maybe you have expertise nobody else has, but that's pretty much it, right? Those are the only real moats you could have, because every other moat takes time to build, or money to build. But those 2 moats, if you have a patent or you have skills, you could, expected value-wise, make more money by selling the patent or selling your skills to somebody who has more money, right? So go working for somebody else or having them buy the patent. The only reason they wouldn't buy the patent is because they don't really believe it the way you believe it, right? Because there's uncertainty about it. So when you think about, like, people talk about Google, when Google started, they had a patent and they tried to sell the patent to Yahoo. They tried to sell it to Excite. They tried to sell it to all of the other search engines. Sergey and Larry, who they were grad students at PhD students at Stanford, they didn't want to start a company. They wanted to sell the patent and go back and finish their PhDs. Nobody would buy the patent. And you look back and they offered it for $1 million to Yahoo, and Yahoo said no. Excite said no. Nobody wanted to buy it because they didn't see how you could make money that way, right? This was before the pay-per-click advertising. So nobody could see how you would make money with a search engine that worked really well, because if it worked really well, you'd lose views. People would search and then would click on something, they would leave, right? So better to keep them on your page and make more money from the ads. But Sergey and Larry were like, well, we don't know how we're going to make money either, but we're going to keep doing this. And Google obviously succeeded. But the reason they succeeded is because nobody understood. There was no way to predict how they would make money or that they would make money, because nobody knew how they would, right? So there was this uncertainty around the market that allowed them to succeed. Anyway, so this is, if you think about this, and I wrote a very long post about this, trying to explore every possible objection. I think that this uncertainty is really the only real moat you can have. The only thing that will keep other people out of your business is the fact that they don't believe you. They don't believe it, right? They can't compute the value of your idea, analytically.
Right. Yeah. I think you capture something really important there, because most of the startups that are so big now, Uber, Facebook, almost every software tech startup, even Amazon, for that matter, they didn't have a moat to start off with, right? It's
right.
Something which a big company could very easily, if they knew what value Uber, Amazon would eventually end up creating, it would have made total sense for them to deploy like a team of 10 people, put $1 million and just build it way before Uber could have had the chance to become a big company. So I think you're totally right on point that there's literally no other moat for a startup than uncertainty.
Yeah, I think it's really interesting, right? And again, this is an old idea. The thing that struck me was that people have mentioned it for a couple hundred years, but nobody ever does anything about it. Like nobody ever says, well, if there is uncertainty, then here's what you need to do. And this actually struck me. I was asked to help teach a Steve Blank lean startup, lean launchpad thing for Columbia. And I went through the training and some of the statements they made. And I think Steve Blank's work is really valuable. And I teach some of it in my class. But I think it's the things that he says are for companies that is for the non-uncertain part, for the predictable part of a business. So if you're interviewing customers, you're finding things that you're finding out facts, right? Facts that exist in the world. So these are not uncertain things. These are things that are already certain. There are facts, right? And he makes a big deal about finding the facts. And you need to do this for any business, a capital S startup or a small business or a big business. You need to know what your customers think and find out those facts. And you do that by going and asking them, right? This is great advice. It's amazing advice. But it doesn't address the real thing, the real difference between startups and small businesses, which is the things that customers don't know. So if Steve Jobs had gone out and asked his potential customers if they wanted to buy a personal computer in 1976, he would not have found facts, right? Nobody would have said, oh yes, I absolutely need a personal computer so that I can build a spreadsheet to do my accounting on, because of course there weren't spreadsheets, right? There were no applications that, none of the things we do with computers today could you do with the first Apple computers, personal computers, right? So if he had gone out and done customer discovery, he would have discovered nothing. There were no facts, but he went ahead anyway, right? He went out and said, every household in America is going to own a personal computer. And why did he believe that? Well, he just said it. I mean, I don't think, there was no way to say like this is true or not. Like if you can put yourself in his shoes back then and say like, well, is this true? It's like, well, nobody knows. It's unpredictable whether anybody will want a personal computer, really.
Right.
And of course now we all have like 10 personal computers in our houses with our phones and our tablets and everything else. But it's there was no way he could have predicted that. It was unpredictable, right? So this was the uncertainty. So sorry, I'm getting off track, but in looking at the claims that this course made for what they did, they said things like, we now know how to build a startup, as if it were a science. Like, okay, we have a recipe for building startups. And this is something I think anybody who's been around for a little while will say, okay, well, you have a recipe for this thing that's really valuable. You have a recipe for building startups. If there were a recipe for building startups, they just wouldn't be that valuable, right? So how can you have a recipe for building the next Google? Like if that, I mean, that would be great, I guess, because then I could just program my computer to come up with Googles over and over and over, and I just, but if that were true, they wouldn't be valuable anymore, right? This is the alchemist's fallacy. If you figure out a way to actually turn lead into gold, gold becomes less valuable, right? Because now there's a ton of gold, right? So this idea that you have a recipe for creating startups is the alchemist's fallacy. You can't have a recipe for creating innovation. It just isn't. That means it's no longer innovation, right?
Right.
So
So
I looked at this and said, okay, well,
sorry,
this is wrong. It's the wrong way to teach this.
The way I understood the concept of uncertainty was, if it can be modeled on a spreadsheet, then a big company is going to do it. If it can't be modeled on a spreadsheet, then a startup is going to do it. But then the question sort of arises: why are big companies obsessed with certainty? What are the fundamental driving forces that they're totally uncomfortable with uncertainty, and that's why startups exist?
So they're not obsessed with certainty, right? So there's the middle ground between certainty and uncertainty is risk, and
right.
Now, and this is a nomenclature problem, because people often, when they say uncertainty, what they mean is risk. Like they don't know what's going to happen exactly. But I'm using uncertainty to mean something more radical, which is you can have risk, which is there's a 20% probability of this, there's a 15% probability of that, but that's risk. Uncertainty is we don't know the probability. Okay? So
exactly.
Just want to make that clear, because it's not really necessarily the common usage in the English language. So companies don't mind risk, right? I mean, life insurers take risk all the time. My life insurance company does not know when I am going to die, and yet they're willing to sell me insurance because they have a probabilistic sense of when I'm going to die. And if they pool enough of these probabilities, they can have a fairly certain, idea of how much money they'll make every year. So that's risk, and companies are fine with risk because they can insure it. They can diversify around a bunch of different risks and know that probably one of them will hit, right? So They'll start a bunch of technology projects, knowing that some of them will fail and some of them will succeed. And if they know that they are measurable in the sense that they can say, well, there's a 20% probability, they know how much they can invest. They know what returns they're looking for. But I don't know if you've ever worked for a big company. Have you ever worked for a big company?
Very briefly.
Okay. I spent the first half of my career working for big companies. And even when I was doing venture capital, my first job, I was working for a big company, and I would go into my boss's office and he would say, well, I want you to do a discounted cash flow analysis of this startup. And I said, well, I mean, it's two people and an idea. I mean, it's kind of silly to project 5 years out. He's like, look, we need to know how much it's worth. Do a discounted cash flow, which, I don't know if your listeners know what a discounted cash flow is, but it involves projecting out for a certain period of time how much money the company will make, for 10 years or so, and then applying some sort of risk metric to it, right? Saying like, well, there's a 20% probability this will happen, and then you can take all those numbers and bring them back to the present day and say, here's how much it's worth today. And this is the kind of how you would value any business if you had all that information. It's the analytically the best way to value. So he would have me do these, and what would happen when I would build this big spreadsheet that went out 10 years for how much money the company would make, and then I would say, well, I know that this company is going to command a $5 million valuation, so I need to have it be worth at least $5 million for him to say yes. And so then I would tweak some of the assumptions, like, okay, instead of 20% growth rate, it's going to have a 22% growth rate, and so I would always get the answer. And eventually he caught on to this. He's like, you've made like 100 assumptions in this spreadsheet, and you can explain each of them, so I'm 99% sure that each of these assumptions is correct. But when I take like 99% sure 100 times, I don't know if this is right or wrong. And I was like, it's right. Just trust me. But I think that's, big companies want to have that certainty, because if you fail, they want to be able to say it wasn't a stupid thing to do, right? Mm-hmm. Now, people always look at venture capitalists. They invest in companies, and the company will fail, and people will go back and be like, well, that was a stupid thing to do. It was obvious to me that it was going to fail. And how do you defend against that if you don't actually have some sort of model, right?
Right.
And a venture capitalist can say, whatever, you don't get it. I don't even have to listen to you on Twitter because you think that I'm dumb. It doesn't matter, right? But if you're inside a big company, you don't have that luxury, because the person criticizing you is maybe your boss or your boss's boss. And if you don't have a rationale, an analytical rationale for doing things, they just fire you. Whereas if it succeeds, they don't give you like a $1 million bonus. So there's an asymmetry of incentive here. But yeah, no, I think big companies, because of the way they're managed, because of these sort of the hierarchical management, the fact that you're entrusting people to do things that you don't control, they have to have this sort of reasoning going on to manage well. It's sort of like, you have to justify what you're going to do, and I'm going to go back and look at your justification afterwards to see if you predicted what would happen correctly. So anybody who's worked for a big company knows they can walk into the boss and be like, hey, we should do this. And their boss will say, well, all right, well, how much money will we make? When will we make money? Is this a good idea? If you come in with a new idea for a business, say, they'll say like, well, how big is the market? Who's going to buy it? How much will they pay? And if you come in and you say, well, I don't know, they're going to say, okay, well, go find out. And if finding out means you have to wait 10 years, well, then they just don't do it, right? Like, why did IBM not jump into the market when Apple was making personal computers? IBM could make personal computers, but they decided to wait for 5 years until after Apple had proved there was a market, because IBM said, well, we don't know, we don't think there's a market here. We don't know if there's a market. We can't justify this.
So the big companies wait for data points to arrive, and by then it's too late for them. A startup has grown too big.
Yeah, well, that's the hope when you're the startup person, right? Is that they won't come in until it's too late. Apple did survive IBM entering the PC arena, although just barely, and most of their competitors did not. But the only reason they survived is they had 5 years to solidify their position to go public and raise a bunch of money. If IBM had come in 2 years after they started, Apple would have failed. They just wouldn't have made it. But then you look at things like, remember Pebble, the smartwatch?
Yeah.
So they raised money on Kickstarter. They were really successful. People loved the idea. People bought the smartwatches. But there wasn't really uncertainty there, right? There wasn't enough uncertainty that as soon as Apple saw them doing this, Apple said, we could do that. We could do that better because we can connect it to our phone more seamlessly because we own the phone. And then they started the Apple Watch, and then Pebble went out of business
Right.
because there wasn't enough uncertainty to keep Apple out of the market long enough that they could get to the point where Apple couldn't put them out of business by just entering, you know?
Right. Hmm. So, I mean, this is a good description of what happens, but I'm curious, what's your advice on this being prescriptive? Can an entrepreneur really control the amount of uncertainty? How does this really sort of enter into decision making of an entrepreneur?
Yeah. Now, this is the big problem, right? Because, and I think this is why most of the people who have talked about uncertainty in entrepreneurship haven't had, it kind of said, well, there is uncertainty, and then gone off and talked about something else. They just
Yeah.
ignore it, because what do you do about things you can't predict? I mean, if you can't predict it, you can't predict it, right?
Yeah.
But you know, the flip side of that is that people do start companies with uncertainty and are successful. And I don't think it's luck, right? I mean, it's not, it can't be just be luck. It has to be skill to some extent. So what do? Right? There are many things they do. Part of, like, the whole lean launchpad idea, right? I'm sorry, not lean launchpad, the lean startup idea of iteration.
Yeah.
Iteration is a way of dealing with uncertainty, right? So you try something, see if it works. If it doesn't, you back off, try something different. This is a great way of dealing with uncertainty. If you think about, what other kinds of uncertainty, what other fields have uncertainty? Well, you know, science has uncertainty, right? So and you think about the scientific process. Well, it's a trial and error process. You try something, see what happens. If it confirms your hypothesis, great. Or sorry, if it doesn't disconfirm your hypothesis, great. If it disconfirms it, you try something else. This is a way of dealing with uncertainty. You know, there's I think there's several ways of reasoning that you can deduct things, right? If you have a bunch of facts, you can deduce things from them. You can induce things from them by saying, well, I've got a bunch of facts. I can, you know, the sun rises every day. I can induce that the sun is going to rise tomorrow. Or you can go out and start trying to find new facts. And the way of finding new facts is trial and error, right? So this is one way of doing things.
Right.
And I think the not having all of the facts is one of the primary causes of uncertainty. Like, there are just things you just don't know because nobody's ever done it before, right? So the reason Steve Jobs didn't know how many people would buy personal computers was because there hadn't ever been personal computers. There was no way of predicting something that there were no facts around.
Right. Would you say, if, say, an opportunity or an idea is too obvious, there is too little uncertainty, and it's clear as daylight that there is value to be created, an entrepreneur should not pursue it because probably they won't be like big enough moat for any valuable business to be created?
I would say that. I think one of the things I'm trying to do is trying to build out an alternative business strategy framework, you know, alternative to the ones that are out in the world already, like Michael Porter, right? Michael Porter is a famous business strategist, very influential, very smart, really useful framework. And what he says is you shouldn't compete, right? Like, if you want to be successful in business, you should avoid competition, right? Avoid doing the exact same thing somebody else is doing. Now, the reason he says that is not that you couldn't possibly be the best, but if you want to compete to be the best, it's a pretty hard row to hoe, right? You know, it's a difficult thing to do. You know, if there were $1 million prize for a foot race, would you rather join the Boston Marathon or, you know, the 5K in some small town in, you know, Oklahoma? Well, yeah, of course, you'd rather have the one with less competition, right? Now, this is not saying that competition is bad. People run races to compete. They want to prove that they're better or prove that they're getting better or whatever. But if what you're trying to do is be successful, is trying to win, then you want less competition. And this is what Michael Porter said is, you know, you should try not to compete. Now, the problem is, if you have an opportunity that's not uncertain, you're gonna have a lot of competition, right? So I think about food delivery. You know, when food delivery, VCs have been funding food delivery companies for, I don't know, 10 years now, right?
Yeah.
You know, and I think about that and I think, wow, you know, it's fairly obvious how big that market is. It's pretty well known what people will pay. There's no real uncertainty here. It's an operationally difficult problem. It's not an easy company to build. But if you start one, what you're saying is, I'm a better operator than anybody else on earth. Because otherwise, you're not going to succeed, right? You're going to have to compete with everybody else who does this. And being a better operator than anybody else on earth is great if you're that person. the people I back usually have never run a company before, right? They're starting, and so them saying, well, I'm better than everybody else on earth at this thing I'm going to do, even though I've never done it. Maybe it's true, right? That could be true. Not the risk I'm looking to take,
Right.
and
Right.
probably not the risk they should be looking to take. So I'm not saying you can't win if you're competing with, all these other companies. I'm just saying that you're more likely to win if you go into a business where you have much less competition. And those are the businesses where there's uncertainty, because
Right.
uncertainty doesn't just keep out the bigger companies, it keeps out everybody. It keeps out, most people don't want to take uncertainty.
Yeah.
So I think you just have a much better chance of building a successful startup if you go into an area where there is a lot of uncertainty, or not necessarily a lot, but there's some crucial uncertainty that keeps other people from entering.
Right.
And this is
Yeah.
why people always say, like, oh, this startup looks like a toy, or it looks, this is a dumb idea. It's because there's uncertainty around it. They don't believe it.
It has to look like a dumb idea. Otherwise,
Yeah.
it's probably already profited away by someone.
Yeah. Right.
Yeah.
I mean,
When
my
you were
best
talking,
investment.
when you were talking about food delivery, it reminded me of the airline industry where you could start another airline. People are going to buy your tickets if they are cheap enough, but nobody makes money in the airline industry. It's notoriously
Right.
unprofitable.
Or I mean, when BankSimple was started by Josh Reich, who used to work with me at my startup, people said to him, that's not going to work. It's just not going to work. And there was not that much. The uncertainty was interesting because we knew how much revenue you could expect from a customer because they were banking customers. We knew how to build the technology in some sense, at least high level. We knew it could be built. We knew there was a big market in some sense, but we didn't know if anybody would actually use it, or how much it would cost for us to bring customers on board. And this last piece, like how much is it going to cost to acquire a customer, was the really big uncertainty. And the reason that it took a long time for us to raise money for his company. I put some money in early, and then it took like 6 months before anybody else would put any money in, because people were like, it's not going to work. It's too hard. You can't compete with the big banks because you won't be able to acquire their customers. It's going to cost too much to acquire the customers. This was the uncertainty, and until it started to work, a lot of people wouldn't even invest. And also nobody else was competing with him in this kind of new market, this neobank market, because everybody else was like, yeah, it's not going to work. Now, once they had succeeded in bringing a bunch of customers on board, and his company was acquired by a big bank, then all of a sudden now there's 50 neobanks, because they all look at it and say, oh, okay, you can do this. You can acquire customers. You can make money doing this. So it's the uncertainty has gone away now that it's been explored.
Right. And if BankSimple didn't have any moats, then obviously it would have been bad for them. They wouldn't have made profit. So really the window of for a startup to stabilize is that period where there is still uncertainty.
Yeah. And I think this is for them, the uncertainty was partly technical. Not so much can you build the technology, but can you connect your technology to the banking system? And partly it was, can you acquire customers? The technology piece, the uncertainty went away as soon as they launched, right? Because as soon as they launched, people knew that you could launch. Obviously, you can see that from the outside. The part about acquiring customers was not visible from the outside, right? So people outside the company couldn't know if they were acquiring customers for less than they needed to or more than they needed to, right? Like if it was, so that uncertainty remained even after they launched and were operating the business. So it gave them time to build a customer base with everybody else still thinking it was uncertain, even though to them it wasn't.
Right.
And this is the kind of uncertainty that can help.
Yeah, this is a really interesting segue into what I wanted to discuss next, which is really types of uncertainty. In one of the posts, you write about not being very enthusiastic about deep tech or companies whose sole business is to solve technical uncertainty. You don't think they're necessarily profitable. And I think you also take example of clean tech as an industry. So can you talk about like these different types of uncertainty, maybe market uncertainty and technical, how they're different and why one of them leads to like higher chances of success than the other one?
Yeah. So this is, I used to believe that what VCs did was fund new technologies. Like there'd be some new technology and VCs would fund it, like the personal computer. And I was talking about this, actually, it was my friend Justin Singer, who we were talking about this, and he was starting a company which was not a new technology. It was in the cannabis industry, very old technology, but it was a new market because all of a sudden cannabis had become legal in some places. And so he said, you don't need a new technology to be a successful startup. And we talked about it, and we realized what it was you needed a new market. A new market would do as well. And again, back to the Steve Jobs example, because it's so familiar, the PC wasn't a new technology. He didn't invent the PC. There were PCs before him. And certainly, the technology that made the PC viable, the integrated circuit, the central processing unit, that Intel was building, was not a new technology either. It was already, 5 years old, and well known. What was uncertain was whether anybody wanted it, right? Whether there was a market for it or not. So we started talking about this, and there are companies that are built on technical uncertainty, right? So Genentech, for instance, is a great example. Genentech took this kind of genetic engineering out of the university laboratory and turned it into a real product. They started making not DNA, insulin, and it became a very successful company. And so there are examples of that happening. I think, especially in places where you can get a patent, right? So in biotech, that sort of thing. I think most technologies that aren't biotech, it's hard to patent. It's easy to work around patents, so that kind of moat doesn't really exist. And again, unless the patent has this uncertainty, somebody else will just buy it for more than you could make on an expected value anyway. So you may start a company because you prefer to start a company with your patent than get the money up front, but that's not really a rational business decision. So whereas new markets are uncertain in a different way, they're like BankSimple. The technology was uncertain until the day that it wasn't, until the day that it worked. And the day that it worked, it was visible to all. Everybody in the world could say, hey, look, BankSimple works, because they launched the product. Whereas the market uncertainty may have been resolved within the company, but it wasn't resolved so that everybody could see it, right? So it was still a moat. Now, I hesitate to say that you should only invest in new markets and not new technologies. I don't think that's true. I think what you have to do is you have to evaluate the uncertainty and how it's resolved, right? How does the uncertainty go away? If the uncertainty goes away in a very visible fashion that everybody can imitate, well, that's no longer a moat. So will you have some other moat by the time that happens? If the uncertainty goes away in a slower, less visible fashion, then you have more time to build a moat. But certainly, it doesn't mean you can't build a moat before if you have technical uncertainty, it doesn't mean you can't build a moat before everybody else sees that the technical uncertainty has gone away. It's possible for that to happen. But then it becomes a sort of an ad hoc thing. I also am not trying to, I'm careful not to do the thing which I was criticizing earlier, which is say, here's a recipe for building startups, right? What I'm trying to do is say, here's a tool set for evaluating startups, right? To let you think about what the progression of what it's going to look like as you build. So I'm not saying, oh, don't invest in deep tech. I invest in deep tech. And I'm not saying you should always invest in new markets. Plenty of new markets I'm not interested in. I'm saying you have to evaluate it using this idea of, you need a moat at some point, and you need a moat before you have a lot of competition. So in the ways that these two uncertainties develop, will you build a moat before the competition realizes that the uncertainty is gone?
Right. So on this on this topic, I've had a few debates on Twitter, and one of the names that keeps coming up is the Elon Musk and what he's done with Tesla and SpaceX. And sometimes, people point out that the culture of innovation and the pace of innovation is itself a moat, and that sort of keeps the company sustaining even if there's no other moat per se. So what's your thought on that? Because like you say, if once you release the product, it's evident as clearly to others as it's to you, and it can be copied. But do you feel there is any merit in this argument that even if that's the case, if a company is innovating really fast, it's founder driven, they still have an edge over others?
I think the idea that this was, when I was younger, people used to say, well, you can't turn a battleship, right? You can't quickly turn a battleship, meaning that a big company is not going to change its ways quickly. And this is true to some extent. On the other hand, IBM did launch their personal computer within a year of deciding to do so. because they took a small group of people, sent them off to Florida to design and build one away from the rest of the company. And then they launched. And how many personal computer makers were there before IBM launched? Probably 20, 25, 24 of them went out of business because IBM launched their personal computer. Now, I think that's a bad bet to say, like, we're going to be able to out innovate a company that has a lot of money. Can you out innovate Apple? I mean, is Apple so stuck in its ways that they can't innovate, or Google for that matter? I mean, I think they're becoming more stuck in their ways, but they're not quite there yet. So, I think if you look at Tesla, when did people become certain that everybody wanted electric cars? Like that this market was actually a really big market? Because I read a lot on Twitter about people saying that Tesla's not a good buy, it's a bad stock to own, that it's inflated because, for it to be worth what it's worth, you have to assume that everybody in the world wants an electric car. And that's just not true. I really think that, to some extent, it's not true, right? Everybody in America wants a big truck. They don't want an electric car, for the most part. So is Ford wrong to keep building big trucks? No, of course not. It's a huge amount of money they're making. In the future, will they all want electric cars? Maybe. I would like to believe that, but it's certainly, there's no certainty there, right? I mean,
Right.
we're all going to stop using, oil burning cars. That would be great. Is that going to happen? I'd like to believe that, but that's certainly, I'm not going to bet on it. So I think there is uncertainty about what Tesla is doing, especially. And it was interesting. I don't think this was on purpose, but they went after the high-end market first. And by going after the high-end market and selling a lot of expensive cars, other car makers could easily say, there's no real market for these cars. It's only wealthy people in California who want them, which was true for years, right? That was who was buying them. And to some extent is still somewhat true. Is there a market for low-end electric cars? Well, we've had electric cars for 100 years, right? When Henry Ford's wife wanted a car, she didn't want one of his cars. She wanted an electric car, and he bought her an electric car, right? 100 years ago, right?
I didn't know
his
that.
cars were dirty and noisy. Yeah, it's true. It's kind of funny. She wanted a fancy car because they were all of a sudden had made this money. So he bought her somebody else's car, not one of his Model Ts, right? So there's always been electric cars. It's just that partly they haven't been feasible. So there's partly a technical problem, but partly I think they weren't really marketed correctly. They were marketed as sort of low end, a small car that you can drive around the city in, not a luxury car.
Right.
Yeah. So I don't know.
Yeah.
I think you could easily make the case there was a ton of uncertainty there.
Yeah, I mean, I think uncertainty and moats are related. I mean, they're joined to the hip. But I think the confusion really occurs in what exactly is a moat, because it's every company likes to believe they have a moat, and I've seen all entrepreneurs sort of dig out whatever they can to say this is our moat. But do you have a framework to think about what really are strong moats? How do you know you have a strong moat versus whether you are probably delusional about your business having a moat?
Yeah, I mean, I actually would use Porter's 5 Fortress framework. I mean, I think it's the simplest, best known way of saying, are there things that are keeping people from competing with you, right? And I think, there are, if you don't have a way of keeping people from competing with you, of actually forcibly keeping them out of your market, maybe forcibly is the wrong word. The question is, if somebody else decided to do this, could they do it today? And the answer is usually with startups, or almost always yes, right? Because if you can do it starting from nothing, then so can somebody else. Then the question is, well, why aren't they? And if the answer is, there's two answers. One is because they don't believe it. They don't believe this is real. And the other answer is because it's not real, right? Like either there really is no market, or people don't believe there's a market. They can't predict that there's a market, right? And if there really is no market, then it's a bad idea. And if they can't predict it, there's a market, then it's not a bad idea, but it's not necessarily a good idea. And if there's definitely a market, but you have a moat, well, okay, then fine. Like you have a patent, something that nobody else has or can get. You've allowed the government to give you a monopoly in some way. I mean, there's plenty of different moats you can get, but if you have one of those, then fine. But if you don't have one of those, one of these, old style, what people, if you read about sustainable barriers to competition, there's a lot of work written on it, right? And all of that, Seven Powers by Helmers is a great book on moats. He doesn't mention uncertainty, right? Because they're not thinking about this framework, they're thinking about bigger companies. But all those work, if you look at any of those moats, if you have one of those, great. If you, but if you don't, and what you have is uncertainty, then you have to evaluate that. And if you don't even have uncertainty, you just have to assume people are going to enter your business, right? If it's a good business. I mean, if it's a bad business, they won't, but that's not a great place to be.
I know you said there's no formula to figure out whether the uncertainty is going to resolve in your favor or not. But I'm wondering if you have any sort of, again, probably you talked about it, but how should an entrepreneur proceed to sort of resolve uncertainty in sort of an optimal way, maybe, with a minimal time and cost?
Yeah. So this is a work in progress for me. This is what I've been working on for a while. And that's really the ultimate goal, is to say, like, here are the different ways to approach uncertainty, to mitigate uncertainty. They're not recipes. They're ways of running your company that will at least not take you down the wrong paths. That's the wrong way to say it, but that are more efficient than doing it otherwise, than just guessing. And the first is, as I said, trial and error, right? Trial and error is a great way to find out more facts and help you figure out whether or not, or find your way through the uncertainty that exists. And trial and error, although it sounds simple, it's not as simple as it sounds, right? There's a lot of different ways you can configure your trial and error process so that you'll get to the place you're trying to go most efficiently. Think of the two trial and error processes I use as an example, and what I'm writing right now is the scientific method and evolution, right? And these are both trial and error processes, but they're very different trial and error processes for a lot of reasons. And I think the way that they're different is more interesting than the fact that they're both trial and error processes. So I don't actually have that. I am still writing that, so I'm still thinking about it. But trial and error, as in the lean startup, is a useful way of finding your way through uncertainty. The second is, a lot of uncertainty comes about because of complexity, right? There are some things you don't know because there's some things that are unknowable because you're in a complex system, and they change as you do things. So you might decide to do something, it changes the answer of what you're trying to get to, right? So science, for instance, the answer doesn't change because of the experiments you run, right? If you're trying to find some fundamental law of nature, the law doesn't change because you run an experiment on it, right? I know that's,
unless you're doing a quantum mechanics experiment,
right? But the laws don't change, right?
Yeah, exactly. Yeah,
you certainly change the answer. Yeah, but if you're going into a new market, like when Uber entered the taxi market, they changed the market, right? I mean, the taxi market, Uber's taxi revenue is larger than the entire taxi market was before they started.
Okay.
Right. I mean, that's just a fact. I mean, it's a fact. It's several times larger. Like, they grew the market by being in it, and by providing more supply. Really, like the market was supply constrained. There weren't enough taxis and enough drivers, so they grew the market, quite a bit by just being in the market. And so their entry changed the market. Now, and it's a complex system, right? So you have to figure out, all right, well, what can the uncertainty comes about because it's complex. When they started Uber, they didn't know this would happen, right? And people criticized them, saying the market's not big enough. But they went ahead and they changed the market by being in it. And there are ways to manage complex systems that will make them less uncertain as well, right? So you can strengthen certain ties between different nodes. You can put limits on the outcomes. You can say, like, all right, I'm bounding the outcomes. There are a bunch of ways you can do this. They sound a little theoretical when I say them that way, but they involve things like partnerships with other people, like putting together the computer industry put together user groups, the personal computer industry. When they started, the bicycle industry put together specifications for bicycles that allowed parts to be made more cheaply because they were mass produced. And there are ways of bounding the uncertainty that exists, government lobbying, this kind of thing, right? So all of these things are well tried, but I think thinking about them in the sense of uncertainty, in the sense of complex systems, gives them a sort of cohesiveness to the approach you take that makes them more useful.
Right. Yeah, it is. I mean, it sounds like a difficult problem to solve, and I'm sure it's a difficult. I mean, how do you control a complex system to evolve in your favor? It just sounds probably the hardest problem in social sciences.
It is. There's a lot of work on it. the social construction of technological systems. I'm not doing anything new, right? What I'm doing is I'm trying to reorganize what's out there with a central framework of uncertainty to have these things relate to each other, because there's a ton of work in entrepreneurship that is really valuable, that I can read and I can say, like, with my 25 years in the startup sector, I can see that what they're saying in this academic paper is really valuable. And then there's a ton of work I read it, I'm like, this is silly, it doesn't make any sense. But the valuable stuff, it's not connected by any framework. And this is the problem with entrepreneurship as a discipline, is there is no underlying framework saying, here's the organizing principle behind our study of entrepreneurship, right? So this is,
Right.
I'm trying to, this maybe makes it sound somewhat immodest. I'm trying to reorganize this so that there is a central underlying principle, which is, this, like I said, one of the oldest ideas in entrepreneurship, which is uncertainty. Oh wait, and then the last idea, sorry, I said those two, trial and error and complex systems. The last idea, I think, in managing, and this is probably the one that is most immediately useful to entrepreneurs and probably the most intuitive if you've been around startups long enough, is you have to not have a set goal, right? You can't say, like, I am going to point A and nothing else will do. It's either this or nothing, right? Being able to keep a flexible goal is probably the most important thing, because as you develop your company, you'll find that what you believed to be true is not true sometimes, and what you believed wasn't true is true sometimes, and what your goal is changes depending on what you find out, right? So this, again, they talk about this in Lean Startup, like, you don't have a set goal. You're trying to get to a place, but not necessarily through a plan, really long-term plan that you've planned ahead, right? You're driving a car, not launching a rocket, right? So you may know where you're trying to get to, but if along the way you figure out that's not the destination, then you change your mind. And this is, I think, every entrepreneur has done this, right? I mean, it's you start out thinking you're going to do this, and you end up doing something completely different because what you found along the way didn't support your first idea; it supported your second idea. So this idea of being flexible in your goal.
I think this also adds weight to the whole idea of uncertainty. You can't have a fixed goal if there is any non-trivial amount of uncertainty in what you're trying. It's just impossible.
Yeah. Well, and I think if you go backwards, you say, like, you look at, I mean, I've talked to thousands of entrepreneurs over the past 25 years, and I've invested in hundreds of them, and I think maybe like 2 of them have actually done what they set out to do, right? Like I said, and I think those are both just coincidences. I mean, it's and that's fine. I mean, that's great.
Right.
I mean, that's what entrepreneurs do, is they have the ability to be flexible.
Right. Yeah. So Jerry, since we are at the end of our conversation, I wanted to maybe end the segment, the podcast, with your thoughts on how VCs work. I know you've written about it, but for the benefit of listeners, can you just talk about how VCs make portfolio and how they should make portfolio, what they're doing right, wrong, and in general, what should entrepreneurs know about how VCs work?
Wow. Okay, that's a big question. I have been doing this for a long time. I mean, I started doing this 25 years ago, so it's hard to compress it all into a short period of time. I think the biggest thing that, especially these days, that entrepreneurs need to know is that VCs still believe in the power law, right? That one company in their portfolio is going to return is going to make the entire portfolio back and be their biggest winner, and that half the companies will fail, and that they really are betting it all on one company, but they don't know which company, right? So they may invest in 30 companies in a portfolio, and they know that one of them will be the big winner and make the most of their money, but they don't know which one, because if they knew which one, they would invest in the others, obviously. And because of that, they only will look at companies that could potentially make them a lot of money, right? Like I have a lot of entrepreneurs, especially these days, come to me saying, I'm going to use the new AI to do something in this small market, and I'm going to build a $30 million revenue company. And I say, well, that's not really what I'm looking for. I'm looking for people who can build $1 billion company. And they say, well, sure, but there's no risk here, right? If you're building $1 billion company, it's because you're taking all this risk, and that would make sense. But there's no risk here. So if you invest, at a $5 million valuation, and I turn it into a $30 million company, and you make 6 times your money with no risk, that's a great investment. which it would be a great investment. I would gladly do 6 times my money with no risk. But I don't really believe that, right? I don't believe there's no risk. And I do believe that they have, the same chance as any other company of succeeding. So if and that chance is small, so that they need to potentially be a very big company. And I think that's the one thing that, probably the biggest thing that entrepreneurs and investors kind of disagree on is, how big does a company need to be to succeed? And look, there are plenty of companies that are lower risk. And this is what I usually tell people who are building the $30 million company at low risk is, you shouldn't take my money. That's crazy, right? Because I'm expecting much bigger returns than you're going to deliver. So we're both going to end up unhappy. Like, you should take money from people who aren't expecting big returns and aren't going to be as much of a pain in the ass about it as I am, right? Because you'll be happier. And then there's plenty of places like, raising venture capital is a bad idea for most people, for most businesses. For 99% of people who start businesses, they shouldn't raise venture capital because they're not going to become a $1 billion business. They don't want to become a $1 billion business, right? People who start a restaurant aren't trying to start a $1 billion business. They're trying to start a company that gives them a job and makes them happy, and they get to work for themselves, which is what I did when I started my venture capital firm. Like, it's not going to be a $1 billion business. I get to work for myself. I get to, run a small business that I don't have to hire 100 people and manage 100 people, which I disliked when I started a, venture capital backed business. It's what I want to do with myself, right? So I'm more like a restaurant owner than I am like somebody who starts the next Google.
Right.
And I'm pretty happy with that, And I think if you're like me, then you shouldn't be raising venture capital money from the outside because that's not what they want.
So unless your company can be the next Google, don't bother. Like,
yeah, and I don't think it has to be. You have to be, and maybe Google's a bit of a stretch because Google's more than $1 billion business. But I think unless you can become a big business, right? And if your company can't ever go public, then I don't invest. Like, if there's not that you will, but that you can't. Like, there's no possibility of that happening. It's just not. It's not the path you're going down. And not that going public is something magic. It's just sort of a rule of thumb for a company that's big enough for other people to want to own it, right? Because at some point I do have to sell my stake to get my money back, or else I'll own a piece of your business until I die, and that doesn't do me any good, right? So I need somebody else to buy my stake for more than I paid for it, and so companies that can go public, that always happens, right? That's sort of the goal. Most of my companies don't go public, and even the successful ones don't necessarily go public. They get bought by somebody else. But if they could potentially go public someday, then that's a company that's interesting to me.
Right.
And if they can't, then it's not.
Great. So yeah, this has been a wonderful conversation, Jerry. I really hope your project of synthesizing entrepreneurship around this principle of uncertainty, it gains more steam, and you keep releasing blog posts, and hopefully you end up writing a book as well, because I do think this idea does glue together a lot of different concepts on entrepreneurship and provides a great framework to think about what is that entrepreneurs actually do. So thanks for doing what you're doing, and really looking forward to more ideas on your blog, and hopefully a book as well, if that's part of your plan.
All right, thanks. And thanks for giving me an opportunity to talk about it. It's nice to be able to talk about it sometimes,
Great. All right. Have a great week ahead. Bye-bye. Take care.
Bye. Thank you.